Jai Bharat to all students. In last lecture, we have discussed about started new chapter which is production. Okay, and this we have discussed about various definition of production and function of production, and also factor affecting production, labor, money. Okay, various types of factor affecting production. Okay, so now in this today's lecture we will discuss about different types of cost. Okay, if we manufacturing something product or something object, okay, we have to there are certain cost: transportation cost, labor cost, machinery cost, rent, you have to pay rent, electricity bill. Okay, so there are different types of cost, but so in this lecture we will discuss these different types of cost. Okay, so uh, when commodity means our product or object, service are produced, various expenses has to be incurred. Okay, there are some expenses. So what are the expenses? Purchase of raw material, you have to purchase something raw material, labor's payment, landlord rent, capital you have required. Okay, so sum of total of the expenses incurred plus the normal profit. Okay, we expect some profit. Okay, so if we work like for whole month or 8 hour job, okay, so we expect some profit, so then we will produce something. Okay, so there are some profit expected by the producer. Okay, so this all the total cost are is called the cost of production. Okay, so let's see some various definition and different types of cost are there. Okay, first of all, explicit cost. Okay, it's simple. Explicit cost in business include all the transaction pertaining to the factor of production utilized by given company. Okay, transaction pertaining to the factor of production. Okay, production के साथ में factor affect करता है. Okay, so how you will require like that. Okay, let's say company's example. We will start with example so you can get the better idea. A complete explicit cost can include employed wages. As I said, wages means salary, but day-to-day wise. Okay, payment made to the purchase of raw material, business rent, mortgage payment, and fees related to purchasing manufacturing equipment. All the these types of example are called explicit cost. Okay, paying explicit cost always require a business to expand cases. Okay, so if company doesn't expand cases on given factor of production, this factor are not explicit cost for business transaction purpose. Okay, and explicit cost can also be variable or fixed. We will discuss this, what is variable cost and what is fixed cost in the next topic. Okay, okay, so this is a explicit cost. You have to remember this example, explicit cost. Okay, we already opportunity cost. Second is, we already discussed this opportunity cost in our first chapter also. Okay, opportunity means opportunity foregone in the choice of one expenditure over others. Let's say I have given the example of, I think, mobile phone. Okay, let's say if I want to buy a phone. Okay, so in market, let's say there are two phone available. One is iPhone, second is Samsung or any other model. Okay, let's say I have only 20,000. Let's say 50,000. Sorry, phone and let's say book. iPhone and phone and book. Okay, book or say laptop. Okay, so for my budget, I can buy only one thing. It's either a phone or it's either a book. Okay, so now let's say I have more requirement over phone to the book. I have to read, and I have exam in 1 month. Okay, so I have to read, so I have more requirement compared to the phone book. Okay, so I will buy for 50,000 book. So price of phones will remain said at is a opportunity cost. Okay, we have forgone this expenditure or this object we will not require in given time. Okay, so now I will not, if say at that time I will buy a phone, that price of book is called opportunity cost. Okay, for choice for the object, if we choice over object for another, then that not buying object price is called opportunity. Okay, example, they have given, I have number of alternative of how to spend my Friday night. Okay, I can go to the movie, I can stay home and watch the baseball game on TV, or go out coffee with friend. Okay, so there are they have three alternative. Okay, so if I chose to go to movie, then my opportunity cost of that action would, I would have chose if I have not gone to the movie. Yes. So if I am going to movie, that watching the baseball game or going out coffee with friend is our my opportunity cost. Not both, only one. Okay, so opportunity cost only consider the next best alternative. Okay, if there are three alternative, then if I will buy this, then our second item will be called opportunity cost, not the all the option available. Okay, just like it said phone. Okay, there are different model are there available. Okay, so if for preference, first of all I will buy iPhone, then Samsung. Okay, so if I buy iPhone, then my Samsung phone is called opportunity cost, not all the brand. Third number Nokia or Motorola or Oppo, Vivo. Okay, only second best alternative action is its that price is called opportunity cost. Okay, now next, total, average and marginal cost. Total cost refers to the total outlays of money expenditure. Okay, both explicit and implicit on the resources used to produce a given output. Okay, all the total cost of a given project. Okay, it's called total cost. Okay, and now average cost is a cost per unit of output, which is obtained by dividing the total cost. Okay, let's say we for given company they will produce 100 mobile phone in a month. Okay, so and their total cost is this that. Okay, so for what is the cost of one mobile phone? Okay, I have to calculate what is the cost of one mobile phone. It's called average cost. Okay, so what will we do if total cost and how many products I will produce. Let's say in 100 mobile phone I will produce in a month. So this all will give the output of one production or cost of one mobile phone. Okay, so it's called average cost. Average cost is called equation is total cost upon number of output. Okay, and marginal cost is the addition made to the total cost as a result of producing just one additional unit of the product. Let's say for this 100 mobile in a month I 1 lakh, total cost is 1 lakh, let's say. Okay, so marginal cost is if I will have to make 101 product, I will add extra product, then how much my cost is increasing, total cost is increasing how much. Okay, so it's called marginal cost. Okay, marginal means if one phone is not working in given 100, so I will use the spare mobile phone. Okay, marginal cost, one margin I have given to the given product. Okay, it's called marginal cost. Okay, only one I have to add product, then how much cost is increased. Okay, what is the total cost of our project. Now next, fixed cost and variable cost. Okay, fixed costs are the expenditure incurred on the factors such as capital, equipment, plant, factory building, which remain fixed. Okay, as I itself word itself says fixed. Okay, it will fix. Okay, in a short run and cannot be changed. Okay, price of equipment, of rent of factory building. Okay, or let's equipment capital. Okay, so fixed costs are independent of the output in the short run. Okay, how much product you are going to produce, it will not depend on fixed cost. Okay, they will make that cost also. Okay, so they do not worry with the output in the short run. Okay, even if no output is produced in the short run, this cost will have to be incurred. Okay, you have to pay rent, you have to pay the if you purchase equipment on rent basis, you have to pay rent is on the equipment also. Okay, so it's called fixed cost. Okay, if even if there is a lockdown, as I said earlier, that in corona, if there is a lockdown, you have to pay the rent. Okay, it's called fixed cost. Okay, no output is produced, but you have to these costs are incurred. Okay, and variable costs are cost incurred by the firm on the employment of variable factors such as labor, raw material. Okay, whose amount can be easily increased or decreased in the short run. Okay, as I let's say in given time, steel and cement's price is generally increase. Okay, audible tail. Okay, so its price can be changes in the short run. Okay, so this is called variable. As the word said, its price changing in given time. Okay, labor's price, raw material. Okay, and the variable cost vary with the level of output in the short run. Okay, as I said that if you produce 10 mobile phone in 1 month, 100 mobile phone in 1 month, and 1000 phone in 1 month. Okay, so you have to purchase different material. Okay, yes, and you also have to make new labor. Okay, so the rent of where salary of labor. Okay, so if you increase your output, then variable cost is also going to be increased. Okay, and if the firm decide not to produce any output, variable cost will not be incurred. Why? Because if there are zero phone to make, then I will not require any raw material, any labor. I will have not to give any salary. Okay, so variable cost will not be incurred. Okay, so this is called variable cost. Then short run and long run cost. Short run cost are the costs which vary with the change in the output, the size of firm remaining the same. Okay, short run are the cost same as variable cost, changes in short time. Okay, they both are the variable and short run is same, but they have given particular different name. Okay, on other hand, long run cost are incurred on the fixed asset like plant, building, machinery and land. This is called long run cost. Okay, and long run cost are same as the fixed cost. Okay, now next types of cost is non-recurring and recurring. Okay, as a word say, non-recurring, not repeating, not repeating. Okay, so this not recurring, these costs that are generally incurred on a once a time basis. Okay, not repeating, once time basis, and include those elements of development and investment costs that generally occur only once. Okay, it will only occurs in one in the all the life cycle of all our product or system. Okay, example say you can get the better idea. Plant arrangement, special tooling and special equipment, production engineering, specialized workforce training. You have to give only this example is only one time occurring. Okay, they are not repeating. So it's called non recurring cost. Okay, they have in all the life cycle they we have to pay only one time. These types of cost we have to pay only one time. Then recurring fees are those charges that you will pay again and again. Okay, cost that vary with the quantity being produced, such as labor and material. We have to pay labor salary at daily basis or monthly basis. Yes, we have to buy material on daily or monthly basis. Okay, so this cost is called recurring. We have to pay every month, every day, okay, every 3 months. Okay, repetitive elements of development and investment cost that may vary with the quantity being produced during any program phase. Okay, engineering effort required for redesign, modification, rework and replacement. Okay, this is recurring cost. They happen every now and then in 2 months or 3 months. Okay, so we have to these costs are incurred every 2 to 3 months, 1 month, every day. Okay, so this is called recurring cost. Next is sunk cost. Sunk costs are unrecoverable past expenditure. Unrecoverable past expenditure. Okay, we cannot recover that cost. It's called sunk cost. Okay, if expenditure is meant, then we cannot cover that cost. Okay, or from the profit. Okay, this is called sum. This should not normally be taken into account when determining whether to continue a project or abandon it. Okay, because they cannot be recovered either way. Okay, it's not recover. Okay, if we continue a project or not continue a project, but that types of cost will not occur. We cannot recover. eh, okay, example, let's say example. Okay, a marketing study. A company spent 50,000 rupees on a marketing study to see if its new product will succeed in the marketplace or not. Let's say mobile phone or any product or any let's say wafer, ice cream, any consumable product. Okay, company spend first make few product, okay, for 50,000 and available to the number of marketplace, and they will see if this product is good or not. Okay, so the after that the study conclude that the product will not be profitable. Our cost is very high, so product will not be profit. At this point the 50,000 is a sunk cost. We cannot recover this 50,000 rupees at any how. Okay, so the company should not continue with further investment in the widget project despite the size of earlier investment. Okay, so this is called sunk cost. We cannot recover that these types of cost. Then say training. A company spends 20,000 rupees to train its sales staff in the use of new tablet computer. Okay, let's say there are new computer are, okay, and worker are old. Then you have to learn them about a computer. You have to give knowledge about computer. Okay, so you have to uh, train your staff, and its cost is 20,000 now, which they will use to take customer order. One software are there will take the customer order. Okay, now the computer proves to be unreliable. Okay, it's not working properly for to take the order. Okay, so and sales manager wants to discontinue their usage, so the training is a sunk cost and so should not be considered any decision regarding the computer. Okay, we cannot recover this 20,000 rupee. Okay, so it's called sunk cost. Okay, next is a break even analysis. a calculation of sales volume in unit required to just cover cost. Okay, let's say my cost is 10,000 and I will produce the 100 mobile phone, sorry, 100 any product. Okay, so what is the cost of my one unit? Okay, it will be 100. Yes, for my one unit price 100 per unit. Okay, so I have to buy a unit more than what price? More than 100 price, then I will make profit, or I will not any loss. Okay, if I will sell this product at 100 price, then I will not make any profit or not make any sales. Okay, so this 100 price is called break even analysis, where no profit or no loss should be occur. Okay, so a break-even analysis focus on the relationship between fixed cost and variable cost and selling price. Okay, at what price do I have to sell that I will not occur any losses or make the profit. Okay, so break-even analysis lets you determine what you need to sell monthly or annually to cover your cost of doing business. Okay, let's say you have to sell 10 mobile phone or 10 product or 100 mobile phone in monthly basis, then you can cover your monthly cost. Okay, monthly all total cost. Okay, so break even point equation is fixed cost divided by selling price of a particular unit. Okay, and we already know what is the fixed cost. Okay, fixed costs are the cost that remain the same regardless of the volume of output. Okay, rent, cost of land, building, machinery, property tax, interest expenses, and variable cost are directly related to the production unit. Okay, if we increase production in unit, then variable cost also going to be increased. Okay, cost of material, wages, daily salary, packaging cost, transportation of finished product. Okay, and total cost is sum of all the fixed cost and variable cost. And okay, and total revenue is the cost that comes from selling the entire production. Let's say I will make 100 phones in month, then in next month I will sell this all the 100 mobile phone. Okay, so it's called total revenue. And now what is the profit? Our total cost is this, and total revenue is this. Profit is total revenue minus total cost. We already know that what is the profit. Okay, profit is realized after the selling the product. Okay, so profit can be computed as the difference between total revenue and total cost of product. Okay, so break even analysis means they have given the point where you cannot sell less than that value. Okay, this 100 rupees I cannot sell unit as a 95 price. Okay, then I will occur as a loss. Okay, so I have to sell particular unit at minimum 100 rupees. But if I want to make profit, then I have to sell at a price more than 100. Then I will make a profit. At 100, I will not occur in any losses or any profit. So this 100 price is called break even analysis. Okay, so it's determine what you need to sell monthly or annually to cover your cost, all the cost. Okay, it's defined as a fixed cost per selling price and variable cost. Okay, so these are the different types of cost. Okay, so in now lecture, what are the different types of cost we have learned? Explicit cost, uh, okay, all the salary, payment, raw material, rent. Okay, it's called explicit. Opportunity cost, that if I not buy that particular thing, that this is called opportunity. If I am going to the movies, then watching the baseball game or out for coffee with friend is called opportunity cost. Okay, next best alternative to the action. And then we have discussed total, average, and marginal. Total means fixed and variable, all the summation of all the cost. Average cost means total cost divided by total output. Okay, so that will give our costing of one particular product or unit. Okay, average cost is means cost per unit of output. Then we have discussed fixed cost and variable cost. Fixed cost is fixed. Okay, if even if there is no output, then you have to pay the cost. Okay, it's fixed. Rent, equipment, okay, it's called fixed cost. Variable cost is labor salary, purchasing of new raw material. Okay, if you not decide not to produce any output in this particular given month or given date, you do not have to pay that salary, that raw material. Okay, so variable cost will not be incurred, but fixed cost is incurred even if there is a no output of no output in our production. Okay, so this is fixed cost and variable. Then short run and long run is just like fixed and variable cost. Then non-recurring and recurring. Non-recurring only once a time. Plant arrangement, special tooling and special equipment, training, workforce training. Okay, production engineering is called only one time cost. Okay, and recurring means salary, material, redesign, replacement, modification. This is the recurring cost. They will occur more than one time in daily basis, in monthly basis, or in 6 month or in yearly basis. Okay, then sunk cost means unrecoverable expenditure. There are different types of example of sunk cost are marketing study and training. If you give training and then you will decide that this system or software will not work, then this training cost you will not recover this training cost, so it's called sunk cost. Marketing study also. Okay, so this is the types of sunk cost. And then break even analysis lets you determine what you need to sell monthly or annually at what price, then your you can cover your cost or you can make the profit. Okay, so it's called break even analysis. Now this is your today's assignment question. We have to write down all of this definition and its example. Definition and example of these 6 different types of cost. Okay, and upload it in a RNWIET application. After that you will make your attendance. Okay, now your lecture is completed.